morning, ladies and gentlemen, mums and dads, boys and girls. Michael.
Yeah, good morning, Andrew.
Good morning, and welcome to Dornbush Download 28, I think we're up to. Look, it's been an interesting last couple of days. You know, we had this euphoria from the beginning of the year where the share market was onwards and upwards, up about 11%. But just over the last few days, the wheels have just, I wouldn't say fallen off, but just got a little bit wobbly. So what's your take on what's going on at the moment?
Look, Andrew, and you could certainly argue we're having a well-deserved breather. You know, the market really, through mid-January, you know, since the European Central Bank decision to basically print money and buy bonds, we saw the Chinese reduce their interest rates. Of course, the RBA reduced our interest rates. So there's been a fair bit of stimulus, and the markets have really enjoyed that, as they typically do, of course. You know, as we've said in the office, the 6,000 point mark was always going to be a big test for the market.
Hair's breadth, 5997, just couldn't quite do it.
Yeah, so that's going to be a big psychological barrier to get through. And look, with the luxury of hindsight, no real surprise to see it bounce and, you know, hit that and sort of start to retract a bit. But you're exactly right. The last week or so, just starting to lose a bit of shine, and whether people are now just taking a bit of profit. A lot of companies going ex-dividend, of course. So a lot of investors now no longer sort of thinking they need to hold the share. They've got the dividend, taking some profits and moving money elsewhere.
And yet, even today, like the share market was down about 70 odd at one stage, or high 60s. It's now at time of filming only down about 50 odd. And it's an interesting, you know, it's only fallen about 3%. But all these people out there in bargain hunting mode at the moment. Anything you're looking at on the buy side?
Yes, Andrew, I've been buying, well, actually, I'll take that back. I haven't been buying Retail Food Group, but it's been one that's popped on the radar. Lucky enough to have a few people in that. They've rallied up very strongly on a very good half-yearly result. So
what do they do? Who are they?
Yeah, so Retail Food Group, and look, the mouth's going to start watering here in a moment. They own Donut King, Gloria Jeans, Michael's Patisserie.
I'm just going to go get something to eat.
Let's do the Homer Simpson. Pizza Capers in there as well.
Okay, I didn't know that.
Yeah, so but the price at the moment around about $7.40. First
$7.40.
Yes, first half profit growing by 46% to 25 million. So the market really liking those numbers. One I'm keeping an eye on. I'd like to see it come back a little bit for the technical analysts out there. The price did gap up between $6.50 to $6.80. And the old rule of sort of thumb in that thing is, that gap will get filled at some stage. And funnily enough, for the Fibonacci followers out there, that also coincides.
Is that like a spaghetti brand? Is it? Or?
This is some people would argue it is. It comes back to around about the 38.2% retracement level. So 650 is probably the entry price for me. But certainly coming out with some good numbers. Dividend yield about 3%. Price earnings around about 21 times. So, you know, it's full. But if they can maintain that earnings growth, certainly looks like one to enter in around that 6.5 mark.
And I think you said the earnings per share growth is around the 40s. So we've spoken before about the PEG ratio, where you're comparing the PE to the earnings per share. So I think you said the PE is around 20 odd, and earnings per share growth is around 40 odd. So that's a PEG of like 2. So that's really compelling. Half rather. Other way around. Half. So as a consequence, we're trying to buy shares with a PEG ratio of under 1. So if they can hit those numbers at a PEG of 0.5, that's pretty compelling. But as you said, the key thing there, targets sort of 650, 680. Selling, look, frankly, given the share market's just a little bit wobbly at the moment, haven't been doing a lot of selling, just sitting back, watching, waiting, seeing. But as we said, as we're filming this, it does seem to be creating a little bit of a floor. So, and we have been continuing to back off a bit on the banks, well, certainly last week anyway. But again, that's for those clients who are overweight banks. And by overweight banks, we're saying more than 45% banks. Anything coming up this week?
Another busy week for us economic-wise, Andrew. Yeah, you know, we had a big week last week. You know, this week business sentiment figures have come out, and consumer confidence figures also just out, and pretty ordinary, and again showing that both business and consumers are a little bit concerned about things. Probably the big news over the next couple of days will be US retail sales figures, and also the Bank of England. Mark Carney, the governor over there, will be having a chat, and I guess giving his 2 bobs worth as to what he reckons is a good, bad or indifferent over there. So
and that's really important here because, if there's talk of like the US increasing interest rates as an example, that will actually put pressure on the Aussie dollar because people will be wanting to buy US dollars because their interest rates are rising. So companies with US dollar earnings, QBE in particular, there's other ones, Sims, etc., anything with high US dollar earnings, CSL, they're going to be very much in the frame. So we're very much looking at what, in particular the US, but as you said, also the UK and how it compares and contrasts with the EU. Michael, anything else?
That's it, Andrew.
Michael, well done. See you next week.
Thank you.